Alright, so um, this video is basically going to help us in the revision of consolidated statement of financial position and then the statement of profit or loss with respect to the associates and then what the subsidiary. Actually, we solved this question during tutorials. No, it was an intervention, and we solved it with TA Kofi. Okay, so I just want to use this question to explain some few things that I think will help us revise for the exams. All right, so, but then before I have the solution already in Excel, but then normally, yeah, so I have the solution. I've typed everything in here, but then I would first want to explain some few things and then we analyze the question before I go ahead to talk about the actual entries in the or the presentation, yes, in the financial statements. All right. So let's quickly talk about the five basic workings. And then based on, I've been hearing some questions on different, especially the net assets of the subsidiary, the computation at that side, and then the goodwill. Okay. So I'll firstly the foundation, as I said earlier, and then use that to explain some of the questions that I've been hearing. Okay, and then we come back to analyze the question before we look at the presentation. Okay, so we all know what the group structure is. So quickly. We know that the group structure basically tells us the proportion or the percentage that a company has been able to acquire as in respect to the number of shares that a company has been able to acquire in the other company. Okay, so we know that if a company acquires from, let's say, 50% and above, okay, we know that the acquiree becomes what? The subsidiary to the acquirer, and then between 20% to 50%, okay, become an associate, and then less than 20% makes you, it becomes just an investment that you are making. Okay. Please, with this video, most of the explanations will be based on how I understand it. So it might not be exactly as some of the TAs or the lecturers explain it. It's based on how I understand it. Okay, that's what I'm going to use. That's what I'm going to use actually to explain this. All right. Okay, so when it comes to the group structure, I've seen two different presentations. Let's say if MTN acquires shares in, let me say, EcoBank. Okay, MTN acquires maybe 75% in EcoBank. Okay, this is the presentation I've been seeing most often, where they'll use the diagram and then in this case, MTN becomes the parent. Okay, assuming let's say MTN acquires another one in GCB, but then this time, 75% in EcoBank, and then let me say 40% in GCB. Okay, because of the percentage or the proportion of shares that MTN has in EcoBank, EcoBank becomes what? A subsidiary, and then GCB becomes an associate, right? With the presentation, normally I don't prefer to go by this because, okay, you can choose to do it this way, but then I saw Mr. Gesinado doing this presentation where he brought the subsidiary here. So in this case, EcoBank, okay, and then maybe GCB. This is the subsidiary. This is the associate. Okay, and then he brought the parents here, NCI, and then the other. Okay, so between these two, let me bring the percentages. 75%. So in this case, the NCI becomes 20%, then the total becomes 100%. Then I used 40% for this side, so 60%, no, 60% becomes the other, summing up to 100%. So normally with this, I prefer to go by this presentation because I'm able to indicate by here the number of shares. So let's say 2 million shares. Their parents are MTN acquired 2 million shares in EcoBank. Okay, I indicate the number of shares by so that when I'm doing any of the workings down there, okay, let me say 1 million. So in all will be 3 million shares here. And let's say the total for this one is 10 million. Okay, so definitely this one will be somewhere around 4 million. And this one will be somewhere around 6 million shares, shares, shares here. Okay, normally I've been doing this instead of this presentation because with this one, I'm able to indicate the number of shares by each of them. Okay, and I perceive this one to be more presentable. Okay, when you go down there, in a computation like the net assets of the subsidiary, you need the number of shares in a subsidiary. And I think there will be another computation where sometimes you normally need the number of shares for the parent as well. Okay, so if you're able to do it like this and you indicate the number of shares by each percentage, when you get to the portion or the place where you are supposed to use the number of shares for your computation, you just go ahead and then you come here and then you take the number of shares instead of you going back to what do the calculations again to derive the portion or the number of shares that they've acquired. Okay, and then under the group structure too, you have the acquisition dates and then the reporting dates. Okay, then maybe they acquired this one in 1st January 2025. Let me say 1st June 2025. Let me use 30th father. And it's simple. 30th June 2025. And then the reporting date is what 31st December 2025. And then when you come here, as in under the associates, maybe we acquired that one on 1st January 2025, and the reporting date as usual will be 31st December 2025. So you see that the reason why I believe we've been doing the acquisition and the reporting date is basically to help us find the post-acquisition period. Okay, and then please don't forget to do your post-acquisition period when you are doing the group structure because you are really going to need it. There are some questions where you'll be doing only the I've seen a question where we were told to only prepare the statement of profit or loss. Okay. So someone might be like, you might not need all the computations in the five basic workings to prepare that one. But then you definitely have to do the group structure and then look for your post-acquisition period. Okay. Because you will be striking, let's say for this one like this, from 30th June 2025 to 31st December 2025 is what? The post-acquisition period becomes 6 months. And this one become what? Let me say 12 months, not just 1 year, 12 months. Okay. So if you don't do this, you wouldn't know whether to strike, let's say, the profits or the values in the profit or loss account of the subsidiary. Okay. You wouldn't know whether to strike them between 3 months, 4 months. Like, I hope you get what I'm trying to say. Okay. So normally this have been doing the group structure. And then let me quickly move on to the net assets. So number two, under the five basic workings is the net assets. Okay. Net assets of the subsidiary. Okay. But then the actual thing is the fair value of the net assets of the subsidiary. Okay. And then this workings is supposed to help us find what? The post acquisition profits. So I remember T.A. Kofi saying that he would prefer to name this second basic working as post acquisition profit computation, because we are not going to look for the net asset, we are going to look for the post acquisition profits. Just that is the net asset that will help us what find the post acquisition profit. So under the net assets of the subsidiary workings, okay, what we normally do is we are trying to find, let's say, from the date of acquisition, okay, to the reporting date, what has been the, let me say, the profits or the reserves, how has the reserves or the profit increased, okay, from the acquisition date to the reporting date. Okay, so from the time that we acquired the subsidiary, okay, from the time that we acquired a portion, let me not just say the subsidiary, but then a portion of the subsidiary, how has its net assets, okay, but then the net assets here, indirectly, we are using the equity, okay, so the changes could be like, the changes might be in relation to equity, it might be in relation to net assets. Okay, we are using net assets because we know that net assets here from the accounting equation, net assets is equivalent to what? Assets minus liabilities. And this should also give us what? The equity. Okay, so if you want to use net asset indirectly is equivalent to what? The equity. Okay, that's why we are normally represent the under the net asset. Normally we bring what? Stated capital first, and then the retained earnings. Okay, so you bring the stated, and then normally with the stated capital, it doesn't change. Okay, so let's say if you're having 1,000 at acquisition, you might be having 1,000 at reporting as well. And then the retained earnings, depending on the question might give you, normally the question gives us what? The retained earnings at the end, as in at the reporting date, because this financial statement, for example, is what? At this financial statement is at what? Reporting. So what they give us, 31st December what? 2025. And then the retained earnings here are what? At the end of the period, okay, as in the reporting date. So if they give you the reporting retained earnings, let me say that one is 500. Some of the questions in the additional information, they will give you what the retained earnings of the subsidiary at acquisition. So assuming that one is 400, okay, but then there are some questions where they will not give you the retained earnings at acquisition. However, they will give you other components to help you with derive the retained earnings at acquisition. Okay, so what do you need to derive the retained earnings at acquisition? You know that the retained earnings is a portion of the profit for the year, okay, that has been retained, or let me say, I'm using the same word, that has been kept instead of paying them out, okay, as dividend. So when a company makes a profit, okay, based on their dividend policy, okay, they are either going to pay a portion of the profits out as dividend and then retain some. So is the portion of the profit that has been retained, depending on the retention ratio, that has been retained, okay? That's what accumulates and gives us the retained earnings, right? So if you don't, you are not given the acquisition period, okay, and then some of the questions to, there can be a situation where the question will be like they pay dividend, they didn't pay dividend, all those things. But then normally with the ones that we've been using the profits to derive the acquisition period, the acquisition retained earnings, I've not seen any that we had to do adjustments in relation to dividend, but then maybe I'm here to see one. Okay, so let's just go by what we have here. All right. So assuming we were not given the retained earnings here, okay, at acquisition, and then the question said that the profit for the period is, let's say, 100. Profit for the period is 100. You know that this 500 is having what the accumulated retained earnings or the accumulated retained profit from the previous years as well as this year, because this one is at what the reporting date. So you can either choose to what subtract this 100 from the 500 here. Okay, this side will be what 500 minus 100, because if you subtract this year's what income or profits from the retained earnings at our reporting period, it will give you the retained earnings before you added this 100, or the retained earnings at the beginning of what the accounting period, which is 400. But then depending on the post acquisition period, okay, assuming we are using the 6 months post acquisition period here, all right, assuming you are using the 6 months post acquisition period, it will not be right for us to use the 100, because this 100 is for the whole year. Okay, in that case, we need to apportion, and then the question normally gives us a clue on that, as in whether the profit was obtained evenly throughout the year. So let's say with this 100, if you want to know the profits that was obtained for every month, okay, it becomes 100 out of 12. Okay, whatever let me 100 divided by 12, it gives us 8.33333, whatever. Okay, so 8.333 is what the profit that they are making what monthly. Okay, and then we are saying that the post acquisition period is what 6 months. So 6 months from the acquisition period to what the reporting we assuming is 6 months. It wouldn't be right for us to use this whole 100, okay, and subtract it from what 500 to get the acquisition period, because this 100 is for the whole year. In that case, we need to apportion or look for the post acquisition period profit, and then we know that a monthly profit is what 8.33. So it becomes what the 100 divided by 12 times what 6 months times the 6 months. This will give you the acquisition profit, or someone can choose to do it this way. You subtract the 100 from the 500. Okay, this will give us what 400, and then 400 is what as at the beginning of 2025. Okay, but then the acquisition period we are considering here is what 30th June 2025, and then let me write the reporting 31st December 2025. All right, so you see that this one here is what at the beginning of the period, and then we acquired the company on what 30th June 2025, meaning you have to add the profit that they've accumulated from 1st January up to what 30th June 2025. That will give us what the acquisition period. So you can either choose to find the profit within the post acquisition period and subtract it from this 500, which is what the retained earnings. It will give you the acquisition what's retained earnings, or you subtract the whole income for the year. Okay, and it will give you what's the income for the at the beginning of the accounting period. Okay, then you find from the beginning of that accounting period, 1st January 2025 to 30th June 2025, how much profit did they accumulate? Then you add it. Okay, so that one too becomes 400 plus 100, and then from 1st January to 30th 1st January to 30th June 2025 is also 6 months. So divided by 12 times 6. Okay, this will also give you what? The retained earnings as at what? The acquisition period. So 400 plus 100 out of 12 times 6 is giving me 450. Okay, and please let me rewrite this one. Someone can choose to write it as 100 times 6 over 12. Please, it's the same thing mathematically. It's the same thing. Okay, what I did earlier was to divide what the 100 by 12 to get the profit for each month, and then you multiply it by the number of months, that's 6. But if you do it this way, you get the same thing. Okay, so this is for the retained earnings. Normally, that's the computation that we do in relation to the retained earnings. Okay, now with the net assets, as I said earlier, we are trying to find at the acquisition date. It's okay, so normally when a parent goes to acquire this thing, the subsidiary, okay, they revalue the assets to find the fair value. That's why I said this one is what the net asset is supposed to be was the fair value of net asset. So they revalue the assets that the company is having. So maybe you go and check their property, you look for their market value as at that date. Okay, so assuming the PPE was 100, and after your evaluation, you realize that the market value, so PPE, let me read them, PPE, assuming the PPE is 100, and then after you revalued it, you realize that the market value is what? 120. Okay, so initially you've recorded 100 PP, you've recorded 100 in your books, and then they are saying that the market value or the fair value is what? 120. There has been what? A 20 increments, a revaluation gain. Okay, there can be a situation where after the revaluation, the PPE would be what? Instead of the book value is 100, let me indicate book value of PPE 100. After the evaluation, you realize that it's what? 80. No, 70 rather. Okay. In these two different cases, case 1, case 2, okay. In treating case 1, you will see that PP adjustment. Because initially we've recorded 100 in our books, okay, and they are saying that now the PP is what? 120. We are doing for um, let me make this one is case 1. Yes, and this one is case 2. Okay, so in case 1, we are saying that the book value was what? 100, and that's what we've recorded in our books. And now, because we've acquired a portion of the subsidiary, I want to know the market value, okay? Because this is going to help us what? Ascertain our goodwill. Okay, I'll get to that. After finding the fair value of the PP, realize that it's what? 120. So there has been what? A 20 increment in the PP. What are you supposed to do with the 20? You add that, okay, to the acquisition period. And then because this 100 has been what? The value that has been recorded in our books from the acquisition to the reporting period, the 20 must reflect in the acquisition and what? The reporting period as well. That's what we have in 2020. And then the question might go ahead to say that, let's say the remaining life of the PP is 5 years, right? It means that you have to what? Depreciate this 20 as well. Okay, so you spread this 20 over the 5 years remaining or useful life. Okay, in a sense that if the PPE is 100, okay, and you are charging depreciation, let's say you are left with 5 years, the depreciation will be 20. Now we are saying that the PP is no more 100, it's 120, and the depreciation is 5 years. It becomes what? 24. But you see that because you were using 100 in your book, the 100 as the value for your PPE, you would be charging depreciation of 20. So you already have the 20 in your books. But then we are saying that because there has been a revaluation gain and the PPE is now 24, you've not charged depreciation of 4. Okay. So in that case, you have to come and subtract the 4 here. Okay, depending on the post-acquisition period. If the acquisition period is for a whole 12 months, you bring the whole depreciation here. If it's for 6 months, in this case, you have to what? Divide this one by 6 out of 12 as well, or multiply it by 6 out of 12, sorry, to get a depreciation. Okay, so now you realize that if the depreciation, the revaluation led or leads towards an increment in what our PP or our net assets, the depreciation will be what charged or will be the opposite. The depreciation is basically the opposite of the this thing. If your asset is increasing, meaning you have to charge more depreciation. So that one too, you less it. But then for this one, case two, okay, case two, we are saying that we've recorded 100 in our books, but then after our evaluation, we realized that the actual market value, okay, of the PP, when you go to the market, if you want to buy the PP, you will get it at 70, meaning there has been what? A decrease of what? 30. Okay. So now, this 30 difference would be recorded PP adjustment. Okay, case two. This 30 will be recorded, but this time will be lessened because indirectly we've already overstated the value of our PP by writing 100 instead of the market value of 70. Okay, and then this 100 has reflected in our book from acquisition date to reporting date. Right. So we have this 30, and then because this 30 was part of the 100, and we charge depreciation with respect to what this 100, in the assuming depreciation of 170, still 5 years, we'll be charging 20 as depreciation. But then we are saying that the assets is supposed to be 70, right? So 70, if you are supposed to charge depreciation on the 70, it will be 14. Now, you've charged more depreciation than you are supposed to. Because you were using 100 as your book value, you have charged depreciation of 20, but the value of the asset, you are saying that it's supposed to be 70. And with 70, the actual depreciation that you're supposed to charge is what? 14, but you've charged 20 in your books, meaning this 6 year. Okay, we need to what? Add it back. You've overstated your depreciation, so we need to add it back. So I was saying that the depreciation is what? The opposite. So the depreciation is what? The opposite of the increment or what's decrease in what the value of the asset. So if the adjustment led to an increase in the value of your PP or your assets and you are adding it, you less the depreciation. That's if there is any. Okay. But if it leads to a decrease in your PP, you add back the depreciation. So the example that we saw, this 30, if you divide it by what? 5, you get a 6. So you realize that initially was 20 and then 14 is giving us 6. If you divide the 30 by the 5, okay, it gives you 6, right? So if you are lessing the PPE adjustments, it means that the depreciation, you add it. But then if you are adding the PPE adjustment, the depreciation, you do what? You less it. Okay, so in this case, you add this one. So this will be the depreciation, excess depreciation. This will be the excess depreciation for this one. Okay, this basically the computation with respect to the PP. A lot of workings come in here, but then we might not be able to write all of them. When you are solving the question and we come across any, I will explain that one too. But then I've been seeing the PP often, and then yes, the unrealized profit. So the unrealized profit that come here, yes, I remember someone asking me this question, or I remember someone asking this question that the unrealized profit, which one has been coming here? Because he has been seeing unrealized profit, one in here, and then sometimes we've been sending one to the group retained earnings. So the unrealized profit that come in here is what the unrealized profit with respect to what the subsidiary. That's when the subsidiary is the one what selling the inventory. Okay. So if the subsidiary is selling the inventory to what the parent, you see that the profits, the margin or the markup, that will be calculated on what the actual value of the goods will stay with what the subsidiary. That's when the subsidiary is the one selling. So let's say subsidiaries, we acquire the goods at 100. I don't know why I'm always using 100. And then the profits that the subsidiary added was what? 20. Okay. And he sold this 20 to what? The parent. Okay. To the parent, this 20 is a cost. But then to the subsidiary, this is what? The sales value or the selling price. No, I can't say selling price. Yeah, the sales value is correct. If it's not correct, you understand it. All right. So to the subsidiary, this 120 is the sales value, and then to the parent, this 120 is what? The cost. All right. So now the subsidiary charge the profits of 20. And then this 20 will be added to the subsidiary's profit. Where is the subsidiary's profit in here? The subsidiary's profit, as I said earlier, is part of what? His retained earnings in here. Okay. So meaning this 120 now the total a ton more parent no, or the other kind of profit no, but we are saying that or the other kind of profit no, good. But we are saying that because we are consolidating the subsidiary and the parents, okay, they have become what? A single entity. We assume they are what? The two companies have become a single entity. So as a single entity, you're not supposed to sell to yourself, right? So this profit that has been what added to the cost needs to be taken off. But then if the parent has sold a portion of this 120, okay, then fine, we are good to go. The portion that he has sold, we have nothing to do with again because that portion no obeton plus the profits no so it's okay. But then if a portion still remains, let's say half of the 120 still remains unsold by the parents, there's a Becca 60 in here in our books. Okay, so with this 60, you will see that 120 now subsidiary needed two costs so as a profit no. A portion is still in this 60. Okay, so that portion will be if 20% of that. So you have 10 of that profit in here within the 10 plus 50 plus 10, giving us what? The 60. Okay, so this is the profit still in what? The parents' books. And then this is what? The actual cost that the subsidiary acquired the distance. So they are having half in their books. Okay, this 10 here is the unrealized profit in the sense that, or the account, subsidiary the profits na account, no, at one parents. But we are saying that as a single entity, you're not supposed to sell to yourself. Okay, so this profit needs to be taken out from what? The subsidiaries' books. Okay, so we will be lessing this 20 from the retained earnings here, 20 unrealized profits. Okay, and let's take notes. This unrealized profit thing, okay, we will use this question to explain what I just wanted to say, but I wanted to do that, but then this question, we'll talk about that, so we'll explain it later on. Okay, this unrealized profit, the sales should be in relation to the sales that occurred within the post-acquisition period. Okay, so if the sales occurred before the acquisition, there will be no need for us to calculate unrealized profit on that. Okay, it should be a sales that happened in within what's the acquisition period or at the reporting date. Normally, the questions that we've been solving, I don't know if we've paid attention to that, but then the statements have been clear. So that sales was within what the post-acquisition period. Okay. So you add this, you get what? The difference between the reporting and what's the acquisition. So the post-acquisition period basically becomes what the reporting period, the value that you get here, okay, less the acquisition period value. Okay, so if you less this one from the reporting or reporting minus acquisition, it gives you the post-acquisition period. Now, because the parent has acquired this profit that you get, so assuming you get AA as a post-acquisition profit for that year, the parent has a portion in it because the parent has acquired, let me say, 75% of the subsidiary. And the portion that the parent was not able to acquire, that's the 25%, okay, will be the NCI. We already know that. So the parent's portion will be calculated on this PAP. So this PAP now, subsidiary, no, Enya for the year, no, assuming that one is 200, okay, the parent will have 75% of this 200, and then the NCI will be giving the remaining 25% of the 200. So 150 and then what? 50, giving us this. So normally this is what we've been taking to the statement of comprehensive income as the share of NCI, as in when we are doing the attribution for the profits. Okay, this will be the profit that is normally taken to the NCI as what? The NCI's portion of the profit, and then the remaining would be for what? The parents. Okay, I would try and then clarify some things on that when we get there. All right. Um, I think I've spent a lot of time on the second one. Let me quickly move on to the third one, which is what the goodwill computation. With the goodwill too, I think there are some, let me say, is it confusion or whatever in here. So with the goodwill computation too, we have it in two. We have two types. That's the full method. Okay, and what's the proportional or partial method. And this one is what? The fair value method. Okay, so depending on the question, so you see that normally when you read the question will be like the policy of the parents' policy is to value what NCI at either fair value or at what proportional method. I think let me see if I'll see that. Yes. So with this one, they said what the father's policy is to value the non-controlling interest at what fair value. Okay. So when the question tells you that the parent's policy is to value non-controlling interest at fair value, it means you're going to use what? It means you're going to use what? The full method. Okay. When a question tells you that the policy is to value non-controlling interest at what proportional method or proportional value or whatever, it means you're going to use what? The partial method. Okay. The basic difference between this fair value method and then what the partial or the full method and then what the partial method is that impairment is the treatment of what impairment, how the impairment, that's impairment of goodwill, how the impairment will be treated. Okay, so the full method is saying that the impairment, okay, will be shared between non-controlling interests and then what the the group retained earnings. Okay, but then the proportional is saying that the NCI is not supposed to have a portion of what the impairment. In that case, you carry all the impairment and then give it to what the parents or the group. That's you send it to the group retained earnings. So you see that when you calculate, you are computing goodwill, you come and less impairment. That's if there is any, you less it from what the goodwill at acquisition to get goodwill at reporting. And then when you go to the computation of NCI, okay, you less impairment from there. And then when you go to the group retained earnings, you less the portion of the parents' portion of impairments from there as well. What we've been doing there, okay, is because most of the questions that we've been solving, the interest, the non-controlling interest is at what? Fair value, the full method. Okay. So when it's at the full method, you share the impairment between non-controlling interest and then what the group retained earnings. But then when you are doing for proportional method, you send all the impairments towards the group retained earnings. The NCI will not have a share. Okay, so when you are doing the full method, normally you bring your purchase consideration, and we know what the purchase consideration is. Okay, so let me just say this. The goodwill, when we talk about the goodwill, is basically the excess of your purchase consideration, okay, over the net assets that you are purchasing or you are acquiring. Okay, so let's say you are buying the net assets of the subsidiary, and then the value of the net asset is what? 30,000, and you are paying 35,000. Let me bring it at the top. 35,000. So you see that the difference is what? Five. Yes, 5,000. This 5,000 is the goodwill. So goodwill is basically the excess of your purchase consideration over the net assets of the subsidiary. Okay. Now, a lot, depending on the method that you are using, certain things might go in there. Okay. So for the fair value method, you have the purchase consideration. Then you add what's the fair value of NCI. Okay, you add it. Then you less what's the net asset. So you see that, let's say you purchased 75% of the you purchased 75% of the subsidiary. Okay. Let me just add this one. Here we had 1,450, 20, 440,000. I don't know if it's correct, but just take it like that. And then let's say this one is 1,500. So that's so the PPA, the difference is, so the difference is, let's say 60. We will not use that. I just want to use this 440 as the acquisition, and then 1,500. I want to use this 1,440 to explain something here. Okay. So we are saying that the parents portion that he acquired, okay, he acquired 75%, and you are paying for that 75%. The 25% remaining, okay, what is the fair value of that 25%? Come and add it to the amount that you paid. Okay, so if you paid, let's say, 2,000, okay, as the purchase consideration, and we know that the purchase consideration can come in different ways. It can be as a share exchange. It can come in the form of loan. You give out loan, okay, to the subsidiary. It can be a direct cash payment, deferred consideration, contingent. So the contingent is when you are waiting for the fulfillment of a condition by the subsidiary before you make the payment. Deferred payment is, let's say you've deferred the payment, okay, you'll be paying them maybe 2,000 cedis in 2 years' time. Okay, in that case, that 2,000 cedis that you're supposed to pay in 2 years' time, time value of money, you bring it to um you find the present value of that. Okay, so that 2,000 that you're paying 2 years' time, what's the current amount? As in, you convert it to the present amount, okay, and you add it to your purchase consideration. So all those will be done in your purchase consideration. You found 2,000 as your purchase consideration. All right. Now, the fair value, when you are going by the fair value method, normally the fair value of the NCI is given in the question. Okay, but then if it's not given directly in the question will let you know that you can take what's the price of the NCIs, as in the share price of the NCI will be given in the question to help you find the fair value of NCI. So you see that for this one, they said for this purpose, okay, for this purpose, the share price at the dates at that date, as in the date of acquisition, can be deemed to be representative of the fair value of what the shares held by the non-controlling interest. So what they are trying to say is that use the share price at the acquisition date to find what's the fair value. So when you come here, I think furthest period market value is this, and then the share of mothers. The mother in this question, the mother was a subsidiary. So they've given you what's the share price for the mother as well. Okay. Normally, when you are doing for the proportion, they will not give you those things because you will not need them. Okay. Normally, when you are doing for the proportion method, you will not use the fair value of NCI. Okay. The computations that I've been seeing, they've been doing fair value of net assets. Okay, or the NCI proportion of net assets. But I'll come to that. Okay, so you find a fair value of NCI, maybe that one is 1,000. Okay, you get 3,000 here. Then you subtract the full amount of what net assets at acquisition. In this case, it was 1,440. Yes, it's 1,440. You less it from it. 3,440. 1,560. Okay, so you see that because the portion that you've acquired is considered to be here, and then the fair value of NCR, that's if someone is to buy that fair value of their someone is to buy that portion that we couldn't buy. Okay, what would have been the market price? Okay, so we add it to it, then we subtract the total net assets, okay, from it. Then it gives us what? The goodwill at acquisition. If there is impairments, you less, so assume impairment of 500, you less, okay, then you get goodwill at reporting. That's what 1060. This is for the fair value method, okay. But for the proportional method, we are saying that because the impairment wouldn't be shared between the NCI and what the parent or the group, you just bring the purchase consideration, okay, 2,000. Now you ask yourself, this 2,000, what are we paying for with this 2,000? We are paying for what? The 75% of the net assets that we are acquiring. We are acquiring 75% of this. Okay, so the 75% of 1,440 is what? 1,080. Okay, so if the 75%, let me write that here. 75% of net assets. 75% of 1,440. I'm getting 1,080. Okay, so we are paying what? 2,000 for this what portion, okay, of the subsidiary that we are acquiring. Okay, so what we are basically going, so I said earlier that the goodwill is basically the excess of the purchase consideration over the net asset that you are buying. Okay, so you are buying 1,080, but then you paid what? 2,000. Okay, so basically the goodwill will be what? The 2,000 minus the 1,080, which is what? Parents share of net assets at what? Acquisition. That's the 1,080. This is the portion that we are buying. Okay, so if you less this from 2,000 we are getting what? 920. 920 becomes what? Our goodwill. 920 becomes our goodwill. Okay. So let me check the slides. The formula for, or the format, yes, the format for the proportional method. They said purchase consideration, then you less the parent's portion of the net assets of the subsidiary assets position, and then I think you less the preference shares. Okay, the parent's portion of the preference shares as well asset acquisition. Then you get what? The impairment. And then you come and less what? Then you get goodwill at acquisition. Then you less impairments. Okay. Impairment in this case, we use 500. So you are left with 420. Okay. It gives you goodwill at reporting. So you see that when you're going by the proportional method, the goodwill values become different. Okay. They become different. Two different things. And then this indirectly will affect the computation of NCI and then group retained earnings, as well as what? The profits attribution. Okay. So when you're going by the proportional method and you're doing the profit attribution, the NCI portion that you're supposed to get out of the profits will be different from when you are doing when you are doing for the fair value. Okay. We'll solve the question. So let me quickly talk about the NCI. NCI, I think we are okay with the fourth working, which is what's the non-controlling interest, NCI. Yes, and then I forgot this. This goodwill at reporting. Okay. There are situations where you can arrive at a negative goodwill. Okay. Normally, we've been getting the goodwill, the positive goodwill, which is treated as what? A non-current asset. But then when you get a negative goodwill, they are saying that you should treat it as a gain. Okay. It will be treated as a gain in what? The consolidated statement of profit or loss. So after getting your gross profits, then you add it what? To your gross profit as a gain, or let's say as an income, the statement of profit or loss. And then when you are doing for non-controlling interest here too, so non-controlling interest, fair value. So if you were using the fair value method or the full method, why is this thing misbehaving? Okay, if you're using the full method, okay, and then let me see the partial method at the side. If you're using the full method, you will bring what? The fair value of NCI here, the one that you calculated earlier on. That's the 1,000. Let me bring it here. Okay. Then you add the portion, the NCI portion of what? The PAP, the 50 here. You add it. Share of NCI share of P post acquisition profits. You add it. And then because the full method, we are saying that they are going to share the impairments. Okay, you are going to split the impairment between what? The parent and then what? The NCI, or the group and then the NCI. You will come and less what? The 25% of impairment. Okay, so 25% of the 500. You get 125. Okay, This will give you the NCI value that will be sent to the statement of financial position, the equity side. But then when you are going by the partial method, okay, with the partial method, we are saying that the whole of the impairment, that's if there is any impairment on goodwill, will be what? Subtracted from the group retained earnings. NCI will not get a share. Okay, so in that case, it becomes what? And then with that one, because you will not be given fair value of NCI, you bring what? NCI share of what? Net assets. Okay, NCI share of net assets, because when we were doing this one, we used what? The parent share of net assets to get what? 1080. Okay, 1080 out of, I think, yes, I did it here. So 75% of the 1440 give us what? 1080, meaning out of the 1440, we are left with what? The 25% of 1440 will give us what? 360. Okay, so under the partial method, you will bring what? This 360, okay, as the beginning balance. Because if you are doing the partial method, I said earlier that you will not be given this fair value in the question. Normally, you are not given. The questions I've seen so far, I've not solved plenty questions though, but then the ones I've seen so far, when you're doing, the policy is to value the non-controlling interest at proportional method. You will not be given what? The fair value of NCI. Okay, so in that case here, you bring the NCI share of net assets, and then it's actually fair value of net assets. So NCI share of what? The fair value of net assets. All right. Then you bring what? The NCI share of FAB, 50. Here, we are not going to share impairments. Okay, so we just add this one and this one, you get 410. Let me add, this one will be 925. Okay, so this is the difference between what? When you are doing for the full method and then the partial method. With the partial method, the basic difference is the treatment for what? The impairments. Okay, and then when you are doing the group retained earnings too, okay, that will be the bit working. Then we will go back to the question and then do justice to it quickly. Okay, so the parent to, you see that in the statement of financial position, normally you are giving the retained earnings for the parents as at the reporting period. So you just bring, I think for this one it was here, retained earnings for the parents, so 12,900. So assuming you're using the 12,900, all right? So either parents balance or balance brought down, whatever, how you name it. If you understand it, you should know how to name it. Okay, so let's say 12,900, and then the parents share of what? The post-acquisition profit from workings too. Okay, let me bring that. It's here. The parents had 150. Okay, so you come and add the 150 to it. All right, and then if the parents, let me bring the impairment first. So for the fair value method, okay, you will bring the parents portion of what? The impairments. Because the fair value method, you are apportioning the impairment between the NCI and what? The group retained earnings. The parents will get 75% of the impairment. Okay, so 75%. of what? The 500. The earlier one was 125, so I think it will be 375. 375. You less that. Okay, but then for the proportional or the partial method, okay, after bringing the parents' balance of 12,900 and the share of PAP of 150, the share of PAP of 150, the prepayment here will be the whole 500 because you didn't allocate any towards the NCI. That's the difference between the partial method treatment of impairment and then that of the fair value. Okay. And then if the parents had invested in what? The associates. If the parent is having investment in associates, okay, you bring parents' share of associates post-acquisition profits, or sometimes the parents' share of associates profit for that year. So assuming that one is let's say 1,000, bring it to 1,000, add it to the parents because parents is getting a profit from there. And then if the parent had sold goods to the subsidiary and then parents need the profit at also no autonomous subsidiary now, that profit will be in the parents' retained earnings. And I've said earlier that the retained earnings is basically the portion of the profit that we didn't pay out as dividend. Okay. So sometimes too, we don't pay dividend at all. So it will be the whole profit. So if there is the accumulated profit, it means that profit is not the two goods. So no autonomous subsidiary is still in here. That's why when the parent is the one selling, we subtract the unrealized profit from what? The group retained earnings. And then if the subsidiary is the one selling, you subtract it from what? The subsidiary's profits. That's in the net assets of the subsidiary that workings too. Okay, we subtract it from there. All right. So the unrealized profit, if is the parent that's selling, you come and less it. Okay. If there's anything that we are supposed to add and we come across it, I will talk about that. Okay. So I think this is the 5 basic workings. Okay. But then with some of the questions, if you are doing for you are preparing only the statement of profit or loss, there will not be a need for you to prepare all these 5 basic workings. But then if you are going to do consolidated statement of financial position, you are definitely going to prepare them. I've not seen a question where we solved for the statement of financial position where we refuse to solve any of what the 5 basic workings. But it doesn't mean that the workings are limited to 5. Okay. If they are associates, you do what? Cost of investments in what? Associates. Okay. Because the associates, we are not having control, but then significant influence. They are saying that we are going to use equity method in valuing it or in accounting for it. We are going to use equity accounting according to IES, is it, something something investment in associates and blah 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 blah. So we are going to go by the equity account, and for that one, you just bring how much you invested in the associates. Let's say the cost of investment in associates is let me say 7,000. Okay, the number of shares that the 40% or less than 50% that you acquired, how much did you pay for it? 7,000. And then associates, parents' share of associates profits, the one you brought up here, you come and add that. If there is unrealized profits, you subtract. Okay. I think that will be all for now. If you come across anything, we will try and do justice to it. I want to finish this one early. All right. So this is it for the basic workings, and then the transfer of assets. The transfer, yes, we can have transfer of PPE. That's when, let's say, the parent or the subsidiary transfers PPE or sells PPE to the other party. Okay. Assuming parent is selling PPE. The PPE is supposed to be 100, and parent sells the PPE to subsidiary at what? It sells it to the subsidiary at 120. So you see that there has been what, a profit of 20 on this as well. But then we are saying that for consolidation purpose, since the two parties are considered as a single entity, you're not supposed to pay dividend to yourself. You're not supposed to earn interest. You're not supposed to make profits or sell to yourself at a profit. Okay. In that case, we have to cancel off this 20. Okay. This 20 is in the books of what? Who sold to who? Let's say it's the subsidiary is the one selling it. I think I said parent, so let me. Okay. So if the parent is the one selling, the 20 profits will be in the parent's group retained earnings. So you have to what? Subtract that 20 from the group retained earnings here, where you come and subtract that. So profits from sale of PP, you subtract 20. For both methods, you still subtract 20. Okay. And then this 120 would be recorded as what? The cost or the book value in the subsidiary's books. The subsidiary will charge depreciation on 120, not 100. Meaning the subsidiary will be charging depreciation on the profits as well. Okay. So it means that you calculate what the depreciation, if there is any, on that profit, or let's say you spread that profit over the useful life, and then you add it back to the subsidiaries, the profits. So in that case, we would have added that 20 to the subsidiaries retained earnings here. So maybe somewhere here. Okay. No. Yes, to be somewhere. Let's say the thing occurred. No, you add it back because we're overcharging the depreciation. No? We're charging on 120 instead of what? Um instead of just the 100. Okay, so you spread, let's say the useful life is 5 years. You spread the 20 over 5, you get 4. So you add the 4 back to the subsidiaries' profits or retained earnings. So basically, this is how you're supposed to go by it, by rate, yeah. All right. So I think the battery is going off, but then let me see if I can quickly analyze the question and then pause for now, and then the next thing we look at the entries. So let's quickly go through. All right. So below, um, below are the separate financial statements of Father PLC and two investee companies which also operate in the same industry as the investor. Yes, and I think this question, they can ask you what are some of the reasons why, or let's say if you are asked, I think with a very multiple choice, but you're not doing multiple choice. So let's say if the parents, the acquirer and the acquiree, they are in different sectors, and you ask whether they are supposed to consolidate. The fact that they are in two different sectors doesn't mean that they are not supposed to consolidate their financial statements. Okay, there are reasons or situations where you will be exempted from what consolidate, and one is when, let's say, you the acquiree, you are also what, a subsidiary. Okay, and then your parent is preparing the consolidated financial statement. In that case, you're not supposed to prepare it. But if your subsidiary Okay, it's in a different sector. It doesn't mean that you're not supposed to, you will still consolidate. Okay, and then another company can be like, on only performance or high, but then the subsidiary no acquire is what making losses. So if he tries to consolidate them, you see that indirectly the consolidated profit might what decrease. Okay, or verify no as a reason not to what consolidate, but then you are still required to what consolidate. All right, so this is a statement of financial position. You have revenue, cost of sales, you have gross profit, distribution cost, administrative expense, finance cost, blah 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 down here. And then statement of financial position, we have property, plants, and equipment. We have investments. When we come to equity side, we have land reserve. There was gain on the revaluation of land here in the other comprehensive income. Let's take note of that. And it was in relation to the parents. Okay. Um, let's go to the additional information. Okay, so all right. Hmm, okay. So the following information is relevant. The following information is relevant. On 1st September 2025, Father PLC acquired 80% of the equity share capital of Mother PLC. So this is what your acquisition dates, your group structure, please, you bring it. All right, the consideration consisted of two elements, a share exchange of 3 shares in Father PLC for every 5 acquired shares in Mother PLC, and the issue of what 100 Ghana Cedi 6% loan notes for every 500 shares acquired in Mother PLC. The share issue has not yet been recorded by Father PLC, but the issue of the loan notes has been recorded. So they've not recorded the share exchange here, this one. They've not recorded it, but the loan notes, this one has been recorded. Okay. At the date of acquisition, shares in Father PLC had a market value of 5. Okay, so this is what we'll be using to calculate the this will be using to calculate. Okay, this 5. That's what we're using to calculate the share exchange, because if the parent is the one issuing shares in exchange for the subsidiaries one, it will be at what the parent's share price. Okay, let's take note of that. And then Mother had a stock market price of 3.5. Remember, I said that when you are valuing, or the policy is to value what non-controlling interest at fair value. It's either the fair value of the non-controlling interest will be given directly in the question, or they will give you the share price of the subsidiary. In this case, it's 3.50. Okay, and then you multiply it by the number of shares of NCI. Okay, to get your fair value of NCI. So assuming you've done your group structure and you've indicated the number of shares of the NCI, you just go ahead and then you multiply it by 3.5. Okay, if you've not done that too, I will also assign your calculation now to get that. All right. Father had earlier, Father had earlier on, ah, Father had earlier on 1st July 2025, sorry, acquired 2.4 million shares in Anchor PLC on stock market at a price of 1.50 per share. Okay, so 2.4 million shares. You look at the percentage in Anchor PLC. They have acquired 2.4 out of what? This is Anchor PLC. Out of 6, out of the 6,000, they've acquired 2.4. So if you do 2.4 million divided by 6, and then the 6 is at 1 cedi each. So if you divide 6 million divided by 1, you still get 6 million. So the number of shares are 6 million. by 100. 2.4 divided by 6 times 100, you get 40%. Okay, so because the investment in Anchor PLC is less than 50%, but then greater than 20%, Anchor PLC becomes what? An associate. All right. At the date of acquisition, the fair value of Mother PLC's assets were equal to their carrying amounts. Okay, with the exception of its property. So this is what we'll be using from here. We'll be using this for the net assets of subsidiary. Okay, the workings too. It will start from this side. So remember I said the net asset is supposed to be fair value of net assets. So when they acquire the subsidiary, they are going to revalue the assets of the subsidiary to know whether the current amount in the books is the same as what the fair value when you go to the market. All right. So when they checked, they said what at the date of acquisition, the fair values of Mother PLC's assets were equal to what their carrying amount. Okay. Meaning the value that they're having in their books is the same as the carrying amount. The carrying amount, which is the value that they're having in their books, is the same as what the fair value when you go to the market. Okay. Now, with the exception of its property, what's happening to the property? This had a fair value of 1.2 million below its carrying amount. Okay, so if the fair value is, let's say, 5,000 in as the carrying amount, we are saying, if the carrying amount is, let's say, 5,000 in our books, they are saying that it's having a fair value of 1.2 below its carrying amount. This will lead to a reduction of depreciation charge. If 1.2, if the fair value is 1.2 below the 5,000 here, it means that to get what the fair value, you have to subtract the 1.2 from what's the 5,000. Please, the 5,000 is not in the question. I'm just, so you get what 3800, or let's say it's 5 million less 1.2, 3800. So the question can be put this way. Instead of them telling you that this had a fair value of 1.2, they could have said that the current amount of the PPE is 5,000. But then after the fair value, after the revaluation or whatever, they found out that the PPE is now 3,800. Okay, in that case, you have to look for what the changes, as in whether there has been what a increase in the carrying amount or there has been a decrease. So, but then this question has given us the difference straightforward. This had a fair value of 1.2 below. Okay, they can also be like 1.2 above. So in this case, you are going to subtract the 1.2 million. So I said earlier that the depreciation will be what the opposite. So if the fair value adjustment led to a reduction of 1.2 below its carrying amount, this would lead to a reduction of the depreciation charge in cost of sales. If you are reducing PP in the net assets, okay, by 1.2, depreciation being the reverse of the net assets adjustment, you add it. If you are less than 1.2, you add a depreciation of what? 50. You will do that in a post-acquisition period. Mother PLC has not incorporated this value change into its separate financial statements. All right. Father Group's policy is to revalue all properties to current value at each year end. On 31st December 2025, the value of Mother's property was unchanged from its value at acquisition, but the land element of Father PLC's property had increased in value by 500. So this 500 increment is in relation to Father PLC. Okay. as shown in other comprehensive income. So that's the 500 we saw earlier. Okay, gain on revaluation of land. All right, the third one, they said sales from Mother PLC. Yes, this is where the problem was. Sales from Mother PLC to Father PLC throughout the year ended 31st December 2021. Now, from 1st September, that's the acquisition period. So this is why you said you have to write, indicate what the post-acquisition period at the group structure to know whether what the post-acquisition period is for a whole year or some months. I think I have to pause it and then charge this. Okay, so I think I got to the sales. Yes. So sales from Mother PLC to Father PLC throughout the year ended 31st December 2025. So we're saying that this sales that they've, it was 12 million. So this 12 million sales was from 1st, um, 1st January 2025 to 31st December 2025. Okay. But then the acquisition date was what? 1st September 2025. And the reporting date is what? 31st December 2025. So June, June, July, August, September. So September, October, November, December, 4 months. Okay, so this is what you have to do the post-acquisition period first before you go ahead to do most of the computations, because if you don't take care, you use this whole 12 months. Okay, I said 12 months. This whole 12 million as what the sales for the year, and then you compute the unrealized profit on this 12 months. But they are saying that this 12,000 or 12 million is for what? The whole year. Okay, so to get a month's what sales, you have to divide the 12 million by what? One. By 12, sorry. To give you what? 1 million what per month. So for every month, they made sales of 1 million. So for the 4 months here, the sales would be what? 1 million times 4 months, giving us what? 4 million. So the sales for the post-acquisition period is what? 4 million. Okay. All right. Now, Mother made a markup on cost of 25% on these sales. Father had 2 million at cost to father of inventory that had been what supplied in the post-acquisition period. All right, let's take this side again. So out of this 12 million, they said that, so the 12 million, as I said earlier, because it's the subsidiary, Mother is the subsidiary in this case, is the subsidiary that is selling to the parent. And they are saying that what Mother made a markup of what? A markup on cost of 25%. Meaning this 12 million is the sales value to Mother PLC. Okay. And then they've given us the markup cost. The markup what on cost of 25%. If 12 million is the sales value and they've given us what markup, you have to convert the markup to margin before you can calculate the profit portion in what the 12 million. Because if you come to this side, they said Father PLC had 2 million at cost. So to father, the value is supposed to be at cost because father is the one buying. And then to Mother PLC, it's supposed to be at what? Sales value. Okay. But the main thing here is that Father PLC had 2 million at cost to Father PLC. Let's forget this one for now. Father PLC had 2 million of inventory that had been supplied in the post-acquisition period by Mother PLC. So they are trying to say that within what the post-acquisition period, the 4 million we calculated earlier, okay, within the post-acquisition period, the supplies that were made, we still have 2 million. Okay, so the 2 million is not out of the whole year, but then within the post-acquisition period. Okay, Father PLC had 2 million of the inventory that had been supplied in the post-acquisition period by Mother PLC as at 31st December 2025. Okay, so if you want to know the unrealized profit, it will be what? 25%, no, 25 over, because over 125. You have to convert what? This markup to margin by what? 2 million. Okay, to get what? The unrealized profit. We will do that in the basic workings. Okay. And then Ivan, in December 2025, Father PLC sold goods to Uncle PLC for 2 million. That's achieving a profit markup of 25%. So Father PLC, which is the parent in this case, sold goods to Uncle PLC. And we know that Uncle is what? The associate from the, yes, from here, realize that the portion of investments in Uncle PLC is 40%, and it's between what? 20 to 50. So Uncle is what? An associate. Now you are saying that Father sold goods to the associate for 2 million. That's achieving a profit markup. So if you want to know the unrealized profits, the general unrealized profit here, and they say the entire consignment remained unsold. So the general unrealized profit will be what? 25 over 125 times what? 2 million as well. Okay, but then it's not the whole 25 out of 125 times 2 million that will go towards the retained group retained earnings as unrealized profit, because the parent has only what? 40% of that. Okay, it has only 40% of what's its investment in associates. All right, we will do that in the 5 basic workings. So let's just proceed with the analysis of the question. Now, Father's investments include some financial assets, fair value through other comprehensive income that have increased in value by what? 300,000 during the year. Now, they are talking about this investment. Yes, Father has an investment in here. Okay, and they are saying that the investments include some financial assets fair valued through other comprehensive income that have increased in value by 300,000 during the year. The other equity reserve relates to these investments. Other equity reserve, where is it? Yeah, relates towards this investment. Um, the other equity reserve relates to this investment and is based on their fair value as at what? 31st December 2024. Okay, so they've given you the value as at what? 2024 at the beginning, and then from that time to the current, to the reporting date, there has been a revaluation which caused the value to increase by what? 300,000 during the year. We will do that. And then there were no acquisitions or disposal of any of these investment during the year ended 31st December 2025. All right. Now, the father's policy is to value, this one I've explained it already. That's when they say that the policy is to value non-controlling interest at fair value, means that in the Goodwill computation, you use what? The full method. In that case, impairments will be treated in both the NCI and then what? The non-controlling interest. Now, for this purpose, Mother's share price at the date can be deemed to be representative of the fair value of the shares held by what? Non-controlling interest. So they are saying that because they are using what? The fair value, okay, to value the what? Non-controlling interest. You have to look for what? The fair value of NCI when you are computing the goodwill. Okay, how did they say you should get the goodwill? I said earlier that some of the questions will give you the fair value of NCI as a whole, and then some of the questions too will give us the price. In this question, we're not giving the fair value as a whole, but then they said the share, we can use mother's what? Share price to find that. So what is mother's share price? Here, there is it. The statement. The shares of Mother PLC had a stock market price of 3.5. So we multiply this by the NCI's number of shares to get what? The fair value of NCI. Okay, and it was determined at year end that 330,000 of the goodwill relating to acquisition of Mother was impaired. All right. Some of the questions will give us impairment straightforward. Okay, in that case, and then since you are using the full method, you can go ahead and treat the impairment in, let me, you can go ahead and treat the impairment in what's the net assets computation. Sanity. Okay. So when you're doing the net assets of the subsidiary, okay, you can come and treat the impairment somewhere here. Because in this case, we are doing the fair value method or the full method. You can come and subtract impairment 330 from this side because indirectly the PAP, this 330 will affect this PAP, post acquisition profit, that will be shared between what? The parents and what's the NCI. Okay, so you know that when you come down here, I already said that when you are using the full method, you will bring a portion of the impairment here and come and subtract. You will bring a portion of the impairment and come and subtract here. And then you will send the 75% also to the group retained earnings. Where is it? Here. So 25% here, 75% here. But then you can go ahead and what? Treat it directly in the net asset because it's going to affect the PAP, and then the PAP will be shared between the parent and the subsidiary. And so if I subtract it from the profit that we are going to share indirectly, I've subtracted it from what? The NCI, because the PAP will be sent to the NCI. Here is it. And to say the balance will be here, and then the 25% will be subtracted here. But then say if it has already been subtracted from this side. Near the balance about say. So if you treat impairments in the net assets, okay, when you are using what the fair value method of computing with non-controlling interest, okay, it's going to affect the PAP for the NCI and then the PAP for what the group retained earnings. The PAP for the group retained earnings. In that case, you're not supposed to come and treat the impairment again. But for the proportionate method, you are not allowed to treat what impairment here because if you treat it here, it's going to affect NCI and then what the group retained earnings. However, under the proportionate method, we said the impairment is supposed to be allocated only towards under the proportionate method. The whole impairment of 500 will be allocated towards the group retained earnings. Where is it? Yes, 500. And none will be sent to the NCI. So in that case, it wouldn't be best for us to treat the best thing wouldn't be to treat the impairment in what the net assets of the subsidiary workings. Okay, but here We are lucky we are doing it at full method, so we can treat it there. And then in this question, when I was doing this thing, the solution, I treated it in there, and then the TA also treated it in there because you see, when you are doing the profit attribution, or yes, the profit attribution in the statement of profit or loss, okay, the portion of the NCI that is supposed to come there, if you don't treat the impairment here, okay, and you want to send the PAP in there, it means that you have to subtract the impairment from that PAP that will be sent there because you are using fair value. Okay, but then if we were doing proportional method and we don't treat impairment here, we are free to just go ahead and use this PAP. Okay, so let's just go straight forward. I think the analysis is fine by now, and then with the foundation so far, can go ahead and then present the solution or look at the presentation itself. I think I have it here in Excel. Yes. Charlie, I'm trying to type here with you. Neatly presented. All right. So I said earlier on that I prefer using this method of the group structure. I prefer using this one, okay, most often as compared to the one that we do the two arrows, okay, because this one I'm able to indicate the number of shares by them, and then I feel like this one is very neat, Bob, and you're able to put a lot of details in there. Then when you need them, you just come back and then you take it straightforward. Okay. All right. So we want to do the group structure very quick for this question. So how do you start with the group structure? We have Father PLC. Okay. And then the investments is in Mother PLC and then Uncle PLC. All right. Parents. Now, we are going to look for the percentage or the proportion that Father PLC has acquired in what Mother PLC. Okay. All right. So on first September, Father PLC acquired 80%. So the proportion has been given straightforward. Lucky for us. So they've acquired what 80%. Means that the NCI will be what 20%. Okay. And the total will be 100%. Okay. But then for me, I prefer to indicate the number of shares by it as well, so that when I need the number of shares for NCI, I just come and take it. For father or say the parent, I'll just come and take it. Okay. The total number of shares for Mother PLC is, you come to equity, and then the share price is 1 cedi each. So if you divide this, 5,000 by 1, you will get what? 5,000. Actually, there are 3 zeros at the top, so it's 5 million. So they are having what? 5 million shares. So in total, we have 5 million shares. Okay, and then the parent has acquired 80% of that 5 million. So 80% of that is what? 4 million shares. The remaining goes to NCI. That's 1 million shares. All right. Let's quickly do for Uncle PLC. think that one I did it somewhere here. Okay, but then let's do it again. So you can bring that one down here. Okay. Oops. Number of shares in Uncle PLC. You know that there's 6 million. This one is since it is divided by 1 cedi, it gives us what? 6 million shares. Okay, and we've acquired what? Proportion acquired. We've acquired what? 2.5, 2.4, sorry. Where is it? It said Father PLC acquired on 1st July acquired 2.4 million shares in Uncle PLC at the stock market price of 1.5. So they acquired 2.4 out of the 6 million. So times 100 gives us what? 40%. Okay, so when you come here, the parent has 40%, and then that one number of shares is what? 2.4 million shares in all. All right. 2.4. Okay. So the portion that we are not having, I remember the lecturer saying that one is other. So and then the T also said other. So I want to use other for it as well. So the remaining 60%. Okay. The total will be 100%. We have 6 million shares in all. So out of the 6 million, we've acquired 2.4. So the 60% remaining is 3.6 million shares that we are not having. So this one is what? Significant influence. In that case, Uncle is what's an associate. And then Mother PLC is what? A subsidiary. All right. Let me clean it down here to make the presentation very neat. Okay. Oh, okay. So neatly presented. And then you bring your acquisition dates, then reporting dates, post acquisition period, very necessary. So because you're having this side, okay, you don't have to draw these lines, but then I want to separate them so that you see which one belongs to the mother PLC, which one belongs to the uncle PLC. So we have acquisition date for mother PLC, which is here on 1st September. So June, July, September. September is 9th. So 1st September 2025, and the reporting date is 31st December 2025, giving us 4 months. Okay, but then for the parents, for the associates, the acquisition date was what? 1st July. So 1st July is what? The 7th month. And we are reporting on 31st December 2025. We have what? 6 months. Okay, so this is basically the group structure that I'm having here. This is it. So you have the parents. Bring it closer so that you see. Okay, so you have the parents in here, and the parent is having 80% of mother PLC, making it what? A subsidiary. And then the number of shares, 4 million. Uncle PS. So we've done up to this side. And the pre-acquisition period. Okay, let me explain the pre-acquisition period. So the pre-acquisition period is basically within that year. Okay. How many months did they spend within that year before we acquired what the number of shares in the subsidiary? So you see that if 4 months is the post-acquisition period within the 12 months or the accounting period, then the pre-acquisition period becomes 8 months. It's not every question that we are going to use the pre-acquisition period. Okay, but then I felt like adding it just in case. And this one, the remaining months here will be 6 months. Right, so this is for the group structure. All right, this one. And then the second one will be what? Net assets, no, of the subsidiary. I think, let me just go ahead and use the Excel. All right. So the net asset of the subsidiary, let's forget about this side for now. This one is for the associates. But I'm person a bit confused here with that part. And so let's just focus on the parent and what's the subsidiaries own. Let's just focus on this side. As I didn't come as Uncle Faber. Yes. So for this one, you see that this is just in relation to Mother PLC. Someone can choose to do the net asset for Mother PLC separately, and then when you come down, you come and do that of Uncle PLC. The reason why we do for Uncle PLC, because if you remember, the group retained earnings. Okay, I said you will bring what the parent share of associates PAP. So you have to do the net assets of the associate as well. So acquisition reporting to get the post-acquisition profit of the associates. Then you look for the parents portion. Okay. But then our main focus will be on the subsidiary. All right. So the stated capital, as I said earlier, normally it doesn't change. So you come to equity, the stated capital of the subsidiary is 5,000. Okay, so you have 5,000 at the beginning, at acquisition, 5,000 as reporting as well. All right, and then we have the retained earnings. In this case, we're giving 4,500 as the retained earnings. This 4,500 becomes what's the retained earnings at reporting. So where did we get the 3,200? Let's check. Did the question give us the retained earnings as at the beginning? And first, other PLC acquired 80%, blah, 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 blah. The retained earnings wasn't given. So in that case, we have to consider what the profits for the period. The profits that the mother PLC is the one in the middle. The profits that they made for the year is what? 3,900. Right, 3,900. So if you subtract this 3,900 from the 4,500, you will get what? Let me, where's the notes? Okay, the retained earnings at reporting is 4,500. Okay, and then we don't know at acquisition X, and so that one is X, and they've given you what the profit of what 3,900. But then you know that the 3,900 is from what 1st January 2025 to 31st December, which is our reporting date 2025. But we acquired a subsidiary somewhere here. Okay. So if they've given you 3,900 from here to here, 3,900 for the whole year, you have to look for the portion, okay, for either this side, okay, and then add it to the retained earnings as at acquisition. How do you get retained earnings as at acquisition? You subtract this 4,000, you subtract 3,900 from 4,500. So 4,500 minus 3,900, you get 600. So at the beginning of the accounting period, you're having 600, right? So if you look for the portion of the profits here, this 3,900, if you divide it by 12 times the pre-acquisition period within the year, the pre-acquisition period is 8 times 8, 3,900 divided by 8, divided by 12 times 8, it gives you what? 2,600. Meaning from this side to this side is 1,300. So this is what I was explaining earlier, that to find for the retained earnings at acquisition period, which is these dates, okay, you can either choose to the retained earnings 4,500. You can either choose to subtract the profit from this side to this side, okay, from the retained earnings at reporting. It will give you the retained earnings at acquisition. Or you can subtract the whole 3,900 from the 4,500. You get 600. So this 600 is what's the retained earnings as at 1st January 2025. When you add the profit from 1st January to 1st this September, which is 2,600. So it becomes 600 plus 2,600. For this side, it will give you the acquisition, or 4,500 minus 1,300. It will still give you what? The acquisition profit. So this is what I did here. Retained earnings. So the 4,500 is the retained earnings as at what? The beginning of the accounting period. Okay, here is it. Asset reporting, sorry. The 4,500 here. Then I subtracted what? 4 out of 12 times what? 3,900. That's what I did in here. The 4 out of 12 times 3,900 will give you what? This. So if you subtract the 1,300 from 4,500, you get retained earnings as at acquisition, which is what? 3,200. Okay, so that's how they got the retained earnings. Now there was property revaluation loss. That one's why I explained it. Okay. Now at the date of acquisition, the fair value of Mother PLC's assets were equal to their carrying amounts. Okay, meaning all the assets, the fair value was equal to their book value. Okay, as in, if you take their financial statements, the value written in there is the same as the value or the amount when you go to the market to go and buy them. Okay. However, the property in here was an exception, in that it had what? A fair value of 1.2 million below its carrying amount. So I was saying that because it said 1.2 below its carrying amount, there has been what? A revaluation loss. Okay, so here is it. So if there is a revaluation loss, you have to subtract it from what the acquisition is, because the revaluation took place in acquisition, but then you're recording the book value at the acquisition date as well as what? At the reporting date. So if you want to reduce it to the fair value, you subtract at what? Reporting and at acquisition as well. That's why I did it negative here. Here. So if the revaluation is subtraction, then the depreciation will what? Addition. So the depreciation of 50 has been calculated already for us. And they specify that this would lead to reduction in the post-acquisition period. So this depreciation that's given the 50 is within the post-acquisition period. Okay, if the depreciation had been for a whole year, and can we calculate 4 out of 12 times that depreciation to get the portion that relates to the post-acquisition period. But here they said what? They said what? The depreciation is for what? The post-acquisition period. We are going to carry all the 50 towards the net asset adjustment. So if you are subtracting revaluation loss, you have to add backwards excess depreciation. Now, there is unrealized profits. If the unrealized profit is here, it means that what was a subsidiary who sold to what the parent. Okay, so where is it? They said sales from Mother PLC. Sales from Mother PLC to Father PLC throughout the year ended 31st December 2025 was 12 million. So I said earlier that this 12 million is in relation to the sales for the whole year. So the pre-acquisition and the post-acquisition. Okay. But then Mother made a markup on cost of 25%. If you want to know the profits that was added to the cost before they sold it at 12 million, you have to calculate what 25 divided by 125, because to Mother PLC, this 12 million is what the sales value, and they've given you markup. Markup is calculated on cost. On cost. Okay. So with the markup to margin conversion, let me add this. With the markup to margin conversion, okay, you can take this clue. If markup is on cost, markup is on cost, and then margin is on sales, you know that the sales value is bigger than the cost, right? So if you are converting from markup to margin, you have to add a profit to cost so that you get sales. So you just bring 25% and then you add it. So cost is, assuming cost is the 100%, you add a profit of 25. Then it gives you what? The margin. Okay, because margin is on sales and sales is bigger than, so you expect this margin percentage to be bigger than what? The markup. Okay, as in the base. The base, please, when you are converting 25 out of 1 to 5, you actually get 20%. Okay, so the base, you take the 100 as cost, then you add the markup portion, which is 25, to the 100 becomes what? 1 to 5. So 25 out of 1 to 5 gives you the margin. So if you're having a margin, you want to convert back to cost, the sales is bigger than what? The cost. In that case, assuming the sales here is, the margin is also 25, it becomes what? 25 over what? 100 minus 25. Okay, then it gives you what? The markup of 25 over 75, because margin is bigger than what? Margin is in relation to sales, and sales is bigger than cost, so margin is automatically bigger than what? Markup. So if you want to convert margin to markup, you reduce the denominator. Okay, so that a bar is small. If you want to convert from markup to margin, you add to the denominator. The bar is big. That's how come I was able to understand margin and markup, because it is all right. Let's come back to unrealized profits. So they say the 12 million here is for what? The whole year. Okay, and then we know that the post-acquisition period is for what? It's just 12 months. But then they further came ahead to say that Father PLC had 2 million at cost. This at cost to PLC. at cost to father. We know that father is the one buying, so definitely it will be at cost to father. Okay, so father had 2 million of inventory that had been supplied in the post-acquisition period. So they are saying that out of that 12 million, some supplies were made in the post-acquisition period. And then that the supplies that were made in the post-acquisition period, father is still having 2 million in his books. So you have to calculate the unrealized profits on this, what, 2 million. And because the unrealized profit was given, the percentage was given in markup, we convert it to what, margin. So we use 25 over what, 125. Let me click on it. I did. Yes. So 25 over 125 times the 2 million. Okay. So the 2 million times 25 over 125. That's markup to margin. I intentionally negated it because when you come down here, on the profit not shame, they will say a subtract. The profit is already in their retained earnings. So you have to subtract it from their retained earnings in here. Okay. To restore it back to the fair value. Now there was impairment. So I was talking about the impairment down here. Lucky for us, I said that the impairment value has been given. So there can be a situation where they will tell you that impairment is, let's say, 10% on goodwill. In that case, you can't just come ahead and then bring the impairment because you have to do goodwill computation first to get a goodwill at acquisition before you less that you come and calculate 10% on that. Okay, but here we are giving the impairment value straightforward. So because we are using what, the fair value method or the full method, I decided to treat the impairment here so that when we are doing the profit attribution in the statement of profit or loss, we will get back to that. This is what I've been saying. Yes, the profit attributable to NCI and then profit attributable to parents. Okay, we took this 124. The 124 is what? The post-acquisition profit. The share, parent share of the post-acquisition profit is 124. It's because we've subtracted what? The impairment loss from it. That's why I went ahead to use the 124. But then if I had not subtracted impairments from it, it means that the value that I'll get here, okay, if I want to look for the NCI here, I'll bring that PAP. Okay, I'll bring that PAP. Share of PAP. Let's say XX. Okay, and then I'll come and subtract the NCI share of impairments X before I'll get the what, profit attributable to NCI before I bring it here. Okay, so because we are here, we are fortunate we are using the full method. I decided to subtract it from what? Subtract the impairment straightforward. Yes, I decided to subtract the impairment straightforward from the net asset so that my bar say I met time 1 to 4 on straightforward. I'm the aquacoshim just to be safe. So in that case, you treat impairments biome or NCI and then group retained earnings because the post-acquisition profit they will call NCI and then group retained earnings now has already been affected by what? The impairment loss. In terms of control, parents' portion of impairment loss bill. And as subsidiaries, NCI portion of impairment loss bill or now subtracting now. We've already treated it there. Okay, so if you sum them up, you get 7,000 as the acquisition what net asset at acquisition, and then you get 7,620 as what net asset at reporting. So to get the PAP, you subtract, what is this again? So to get a PAP, you basically subtract what? Let me click on that one. Yes, you subtract this D26, which is what? 7620. Okay, I've done it here. 7620 minus 7,000. So you subtract the 7,000 at acquisition from what? At reporting, you get the PAP. You do the parent share of it, 80%. The parent share is 80% of it, and the NCI is 20% of it. Okay, now let's come down to goodwill computation. Now with the goodwill computation, as I said earlier, so some people will choose to do the purchase consideration somewhere, and then they will bring it to the goodwill computation. But because they said 5 basic workings, they added the purchase consideration to the goodwill. That's why I also decided to do it as part. But then some people normally do the purchase consideration as a workings on its own, and they will carry the total and then bring it here. All right. Let's look for what goes into the purchase consideration. Now, Father PLC acquired 80% of the equity shares. Okay, the consideration consisted of two elements. The consideration consisted of what? Two elements. A share exchange of 3 shares in Father PLC for every 5 acquired. In the 5 shares biara yɛbɛgye biara no yɛbɛma mo three for what? Every 5 acquired. Okay, so 3/5. Here is it. 3 shares in Father PLC for every 5 acquired. So 3/5. Now, we look for the number of shares that we've acquired. So see that this is what I was saying earlier. That the group structure, when you do it this way, you're able to add the number of shares to it. But it doesn't mean that everyone should go by this, please. You can choose to do the arrow this thing. Okay. So with this one, I know that the parents acquired 80%, which is 4 million. So I just come here and then write my 4 million. In this, let me indicate all the 4 million here. Times what? Because it's the parent that's issuing 3 for every 5. You use the parent's price, the parent's share price. Please, it used to confuse me earlier whether to use the parent share price or the subsidiary share price since they've both been given. They said Father PLC had a market value as in office shares at what? 5, and then mother's own is what? 3.5. This mother's own is for calculating NCI. I've explained it already. And this is what we are using for the share exchange. Okay, so the parent is the one issuing shares, so it will be at the parent's share price 5. Okay, what did they get? So this is what we're having here. So 3/5, that's the ratio. 3 for every 5 times what? The 4 million shares. 1, 2, 3, 1, 2, okay. 4 million shares times what? 5 Ghana cedis per share. So yes, we're having 12,000. We're having 3 zeros at the top already, so it's still 12 million. And then that wasn't the only consideration that they gave. They said what's the issue of 100 Ghana cedis 6% loan notes for every 500 shares acquired in what? Mother PLC. So it's the same as if you're acquiring 4 million shares. Okay. And then you are saying that for every 500 out of this, you're going to give 100. For every 500. So how many 500s are we having in this 4 million? You choose to divide it by what? 500. So this one is shares. This one is also shares. The number of 500s that you are having here, we are going to multiply it by what? 100. Okay. This can be rewritten as 100 over 500 times what? The 4 million shares. Okay, so for every 500 in here, you are going to pay 100 for it. The same as 100 over 500. So this one is in Ghana cedis. This one is in shares. It will give us what? The loan note. So here is it. 100 over 500 times this, and we are getting what? 800. So you add the two, it gives us what? The total cost of investment or the purchase consideration is the same thing. And then because you're going by the fair value method, you add fair value of NCI to this. And then how do you get a fair value of NCI? The portion of NCI, the number of shares of NCI is what? 1 million. And the price for each is 3.5. So we have what? 3.5 Ghana cedis times 1 million shares, giving us 3,500,000. All right. So you get a total purchase consideration plus this gives us 16,300. And then you less what? The net asset at acquisition. That one we had 7,000. Here is it. Okay. Less net asset at acquisition. That's negative. You get 9,300. So the 9,300 is the goodwill at acquisition. Okay. Goodwill at acquisition. But then because we are having impairment 330,000, which has already been given, you subtract the goodwill at acquisition to get goodwill at what? Reporting. So this is what will go into the statement of financial position. So imagine if we were not having impairment or there was no impairment in relation to this goodwill. This would have been sent or carried to, we would have taken this 9,300 as our goodwill and then sent it towards the statement of financial position as goodwill as part of non-current assets. And then I said earlier that in case you end up having goodwill to be negative, it means that it will be treated as a gain. In that case, it will not go towards statement of financial position, but rather statement of profit or loss. As a gain, you add it to your income, maybe other income or something. And then when you come down to non-controlling interest, you give the NCI share of the goodwill, parent share in group retained earnings, parent share of the goodwill as well. All right, let's move on to non-controlling interest. Fair value of non-controlling interest. You've done that already. I said some of the question will give you the fair value. So some of the questions will give you the fair value itself. Okay, maybe 3,500. Normally it comes in this statement. Instead of somebody with amount, they will give you what? The fair value amounts. Okay. But then in this case, they chose not to give it directly to you, but then they give us the price, the market share price of what? Mother PLC. So you multiply that with what? Number of shares of the NCI. And we did that when we were computing the goodwill. Here is it. 3,500. Okay, that's why I wrote workings 3 here. So that when you go up here, you'll get it. All right. Then you add NCI share of post-acquisition profits. That one was in workings 2. Open it, I'm sure. Yes, it was in workings 2. I've indicated it. Where is it? It's here. The 124. So you add the 124 to it. 124 to it. So that would be all for non-controlling interest. Now, we didn't bring the impairment here because I've brought it here. I've treated it here in the net asset. So it has already been factored into what? This post-acquisition profit. And I share post-acquisition profit now. So the portion that of the impairments that should have been sent towards the group retained earnings, Okay, why we subtract 1? It has already been subtracted from this PAP. The end payment in Babylon. Okay. Now group retained earnings. So you bring the parents retained earnings. It's already in the question. The parents retained earnings is here. The parents retained earnings. Why? The parents retained earnings is here. 12,900. Okay. So that one. Okay. So it's here 12,900. And the parent share of subsidiaries post-acquisition profit is 496 years. It's 80% of 620. 80% of 620 will give you 496. You bring that one to, and then because the parent has invested in what the associates, you bring the portion of the parents portion of what the associates post-acquisition profits. So now you see that if we had not done if I had not done the post-acquisition period for Uncle, Kafin I wasn't back now, but that's why normally for me, I'll do that of the associates alongside the mother. Okay, so how do you do for Uncle PLC? Just like we did for the subsidiary, you bring the retained earnings and the stated capital. So the stated capital for, sorry, the stated capital here for Uncle PLC is 6,000. Okay, 6,000. So you bring here, normally stated capital doesn't change. So 6,000, 6,000. And then the retained earnings was given as what? 5,000. Okay. If retained earnings is 5,000 in here, okay, how did you get 1,600? Just like we did for the subsidiary. Okay. Here, the post-acquisition period is 6 months. And then we are having profit of what? 6,800. We have profit of 6,800. Oh, sorry. We have profit of 6,800. Okay, for the year, as in relation to Uncle PLC. Okay, it means that this 6,800 is for the whole year, but in the post-acquisition period is just for 6 months. So you divide this 6,800 by 12, and you multiply it by the 6, which gives you what? The post-acquisition period's what? Portion of the profit. So if you subtract the portion, let me calculate it, and then so 6,800 basically should be divided by 2, 3,400. Right? It means that 3,400 relates towards the post-acquisition period, and then 3,400 relates towards the pre-acquisition period. Okay, because you're looking for the retained earnings here. So this is what I did. 5,000. Here's the 5,000. 5,000 minus what? 6 out of 12. I've done that here already. 6 out of 12 times what? 6,800. This gives you what? 3,400. So if you subtract the post-acquisition profit from the retained earnings as at reporting, it gives you retained earnings as at what? Acquisition. That's 1,600. So you add the two, and then there were no unrealized profit or anything in relation to what the associates. If there had been any unrealized profits, that's when the associate is selling to the parent and can say, Rabbit, TFNI way no more has a okay to reduce retained earnings nowadays. But in this case, there was none in this question. It was rather the parent that sold to the subsidiary. Into the profit, no, unrealized profit no, is in the parent's what? Where is it? It's in the parent's retained earnings, unrealized profit from sales to associates. Okay, so I will explain that when we get there. Okay, so we we got 7,600 as what the acquisition was net asset, and then 11,000 as the net asset at report. You subtract, you get 3,400. Is it 11,000 minus 7,600? 3,400 as the post acquisition period, and you share it amongst parents and what the other. In this case, you didn't use what's NCI because indirectly we are the NCI. Okay, so we just look for the parents share. So let's just call it parents share. So I saw it somewhere that you don't calculate the remaining portion because indirectly you're not going to use it in here. There's 60%, but then just for you to sum up to the amount, I just did it just to be safe. Okay, let's come back. So that's how come we had the parent share of the post-acquisition profit from workings to. Now the unrealized profit from sales to associates. Let's come down here. Okay, it's in here. In December 2025. So you see that December is in the post-acquisition period, right? Father PLC sold goods to Uncle PLC, the associate, for 2 million, thus achieving a profit markup of 25%. This 2 million is a sales value to Father PLC, but a cost to Uncle PLC. Okay, and then the profits on markup, the markup profits has been given. So you have to convert this markup 25% to margin to get what's the percentage that is supposed to be calculated on this. So 25 out of 125 times the 2 million. And because we are looking for the portion that's we didn't obtain the whole of the associates. We only had what? We only have 40% of the associates. Okay. So you apportion the unrealized profit as well. So times 40%. That's what we are having here. So 25 out of 125 times 2 million times what the 40% gives us the unrealized profit from sales to associates. Okay. It's only the portion because we are doing it for associates, it's only the parents portion that will come here. The associates is what's different from the treatment for associates is quite different from the subsidiary. It's only the parents portion of its investment in the associate that will come here, not the whole unrealized profit. Let's take note of that. Okay, but then if there is the associate that sold to the parents, the retained earnings will be in the 60%, as in the actual parents of the associate, because yeah, or 40% payment NCI indirectly. Until the profit will be in the associates group on only retained earnings. Okay, but because we are the ones selling to associates, any ever recorded this portion of what the unrealized profit. All right. Then you add, then you subtract the unrealized profit, you get 14,596 as the group retained earnings in here. Then the cost of investment in associates, as I said earlier, cost of investment in associates, we bring the cost of investment 7,000, then the parent share of associates, PAP, you add it, and then the unrealized profits, okay, from the intra-group sales between the parents and then the associates, you less it, okay. So the consideration, let's check where the consideration is. Here is it. It said father had earlier on 1st July 2025 acquired 2.4 million shares in Uncle PLC. So they acquired 2.4 million shares. This is the number of shares. This is the number of shares. But then how much did we pay? You multiply the number of shares by the price of each share in Uncle PLC on the stock market. You got top shares no stock market, right? So you buy it at the price that was given to you at the stock market. This one you're not going to give, you're not going to use the father's market price of 5. We a share exchange there. This 5 no, was used for the share exchange because we were giving shares, okay, to Mother PLC. But for the associates, we are rather what buying shares. And able to your 1.5 times what the 2.4 million shares. And that's what we did here. We had what? So 1.5 times 2400 give us what 3,600. Then you add parent share of associates post acquisition profits. It's here. Parent share of the post acquisition profit of what the associates 1360. Here's it. So I've indicated workings to 1360. You brought it here. And then the unrealized profits. What we did here. This 160. Okay. It will come here. You come here because the unrealized profit is in the associates post acquisition. Let me not put it that way. I say the assembly bar. The parent portion of the unrealized profits. Okay, as I said earlier, the associate's own is different from what the subsidiary. So you're not going to treat the whole of the unrealized profits. Okay, parents sold to subsidiary, and then they're having a portion of the profit in their books. Okay, so entering a double way. So you have to subtract the portion of the profit in what the associates post-acquisition profit. You have to subtract the unrealized profit from it. Okay, so indirectly we are subtracting this 160 from this 1360. Instead we are 1360 be kobiano. Anyway, unrealized profit we in it. Into your bar say yes, and in it never subtract it from. Okay, so assuming we were going to do the profit attribution, and I share a portion of the profit to the associator, even though we don't do it, but we would have subtracted this unrealized profit from the post acquisition profits of the associates, parents' share of it. Okay, we subtracted this unrealized profit from it. Okay, but because we don't do that, it ends here. So we subtract, then we get 4,800. So this cost of investment in associates will go to the statement of financial position as a line item on its own. Right, let's quickly go to the statement of comprehensive income. A statement of profit or loss. Yeah, here is it. That one too. Okay, so the 5 basic workings are here, and then the consolidated statement of profit or loss is also here, and then the consolidated statement of financial position is also here. So when you get, if you're lucky and you get the Excel, then you sorry, then you use that to check. All right. So quickly, we have revenue in here. Revenue 92500. That's the farthest revenue of 92. It's not 92500. And then the mother's own is 45,000. But you see that the 45,000 for mother is for the whole year. And then we acquired mother somewhere in September. So we can't use the whole profit of mother and then add it to our own share. No. You have to take the post-acquisition portion of that profit. That's why we strike 4 out of 12 by what? The 45,000. So all the values here, except what? The tax. We're going to calculate 4 out of 5, 4 out of 12 of all of them. And suddenly I have added parents in them, which is father's own. Okay. So you see that this one we did 92,500 plus 4 out of 12. Post acquisition, cost of sales, we did 4 out of 12. Distribution, we did 4 out of 12. Admin expense, 4 out of 12. Income tax. Hey, okay, income tax and CAA. Sorry, you. So we do it for all of them. Is the consolidation, the statement of financial position that we don't what apportion it. That one we take because these values here are as at a specific date, and this one is for the year ended or for the period ended. So this one is for a whole year, but this one is as at a specific date. These are the balances in our books. Okay. So you take revenue 92,500 plus 4 out of 12 times this. And then you remember we had what? We had intra-group what? Sales. Where is it? Yes. So they said that there was a sale of what? 12 million from Mother PLC to Father PLC. Okay. So we have to subtract it from revenue. When there is intra-group sales, you have to subtract the intra-group because you're not supposed to sell to yourself. So you subtract it from revenue and then you subtract it from what? Cost of sale as well. So this is it. Oh, okay. We did, we subtracted 4 out of 12. Now, the 4 out of 12 here is not, um, let me see, it's because they said there's 12,000 sales. Okay. It's for the whole year. And then we are looking for the transaction that took place within what the post-acquisition period. That's why we are using 4 out of 12. But then some of the questions, the value will be given for the post-acquisition period. In that case, you don't do 4 out of 12. Please, this one we are doing 4 out of 12 for the intra-group sales because they said what the 12 million sales is what throughout the year. So you need only for the post-acquisition period. That's why I've indicated here sales. Okay, so you do this, you get 103,500. And then the cost of sales, 50,500 plus. Sorry, 70,500. Where is it? 70,500 plus 4 out of 12 of this. Okay, then you less the sales. So the sales, the intragroup sales, you see that when someone is selling, you will record it as sales, and the one that is receiving will record it as purchases. And the obiara recording sales was obiara recording the purchases was is subtracted from both sides. Okay, and this is the unrealized profits here. This unrealized profit on the intragroup sales, we calculated that that's 2 million times 25 out of 125. It's in here. So to subtract the unrealized profit now, indirectly, it's part of this revenue. Okay, so to subtract it from it, you have to bring it here so that this 400 would reduce this amount. So we subtract the intragroup sales and then we add the unrealized profits. Okay, now you would remember we had depreciation in the net assets as well. Depreciation of 50 in here. That's we add back depreciation. Now we are adding back this depreciation because we had property being what or let's say the value of the property ended up what reducing by 1,200, and they said the depreciation is what 50. So we are adding it back. Adding it back here doesn't mean you are going to add it here. It has already been overstated in here. Okay, so from the example that I was using, I said, let's say the depreciation, you charge it on 100, you charge the depreciation of 20 if it's 5 years remaining. And then now we are saying that it's the actual market value is 70. If you charge depreciation of 5 years, I think they said they had, assuming you get 15, okay, you will realize that you were supposed to charge 15, but you've charged 20. Okay, because this is what you have as your book value. That's the 100. You have 100 as your book value, but we are saying that the market value is 70. So it's the market value that we want, not the book value. And you've already charged 20, meaning you've overstated your depreciation. So you have to come and what? Reduce it. That's why you are subtracting the 50 in here. Okay. Then you should be fine with that. And then we come down to what? Our gross profit. Now, with respect to the goodwill, I was saying that assuming we had a goodwill that was what's negative. Okay, here we had a positive goodwill, but assuming the goodwill was negative, and be treating as what? Income. Okay, into and after gross profit near the above gain on goodwill or negative goodwill near the above account profits no as a. But then in this case, you had what? Positive goodwill, so we are good to go. So distribution cost, you just take this one and then you strike this one as 4 out of 12. Administrative expense. You take this, you do the striking. Finance cost, it was only in relation to further. So you bring all the 100 here. So you add all the expenses, then you subtract, and then you come and subtract the income tax as well. I forgot to talk about the impairments. We had impairments on goodwill. Impairment is also treated just like depreciation, an expense. So you brought it as a line item. You add it to all the expense, then you subtract. You get profit before tax. Then you bring your tax. Where is it? 3900. You strike this 1500. You get 4400. You subtract. You get profit for the year. So it is this profit for the year that we are going to share at this place. Okay. Now, there was gain on land revaluation. It was already reflecting in what the books here. It's only for the parents and it's part of what's other comprehensive income. So you come and write that. And then the question said that with respect to investments, okay, father's investment includes some financial assets, fair value through other comprehensive income that have increased by what? 300. Okay, so if there has been an increase by 300 of what? The fair value, you just bring it here, you add it as part of what? Other comprehensive income. Okay, so you see that both of them are what? For the parents. It means that when you are sharing the profits, when you are sharing this total comprehensive income, okay, this 500 and 300 no, NCI only be, okay, they will all go towards the parents. So when you were sharing this profit for the year, you bring this NCI that we calculated in workings too. That's NCI share of post-acquisition profits 124. Okay, you subtract it from this amount, it gives you this, the parent share. So the total should give you this. So this is profits for the year, profit attributable for the year. And this one, total comprehensive income. That's why this one is total comprehensive income attributable to parent and then NCI. Okay. Let's quickly move on to the statement of financial position. Down, we don't strike anything. So you just take this one, you add, you take this one, you add, you take this one, you add. Now, PP, you take 25, 500, 13,900. You add, and then we were having what's the reduction in property, plant, equipment. Where is it? Here is it. They had a fair value of 1.2 million below. So if it's below, you come and subtract. Okay, that's why you're subtracting. And then the depreciation will be the opposite of the fair value loss, which is what add. All right. Now, when you come to the other, the investment in here, 5400. The investment of 5400 includes the investment in the associates. In the investing in associates, no, you try. Now, yes, I invest in other, yeah, what other investments? You indicate here, no. Okay, so all our investments, let's sum it up to this 5400, including what? The share issue has not yet been recorded by further PLC, but the issue of the loan notes has been recorded, including our what? Loan notes. Okay, they recorded loan notes now as part of what? Our investments. But share the recorded here, so you have to add the shares value to what? Stated capital. And they were recorded. But loan notes then also more recorded, but then only recorded with other investments. It is not supposed to be parts of that. All right. So to get the actual investment, and you know that the investment in associate is supposed to be treated as a line item on its own. And then you calculate what down has in investment in associates. Yeah, it should be treated as a line item on its own. But at the date of acquisition, they recorded this as the amount that they purchased. So this 3,600 is part of what? The total investment. Why is this thing not moving? It's part of the total what investment. So you subtract that. Okay. And then where is this 300 coming from? Okay. They said what? Investments include some financial assets, comprehensive income that have increased. All right. So it should reflect in our other investment as well. So it's 5,000, 5,400,000 minus 3,600,000 plus the increase in investment. You add it, and then the new investment in associates as a line item, you bring it. We've done that already. Then goodwill. The money reflects what I say, bio. Yes, someone better or has say. Okay, so you subtract it from the 3,600. That's the initial investment in associates, the value, consideration that we paid. You subtract it from here, then you bring it here. All right, and then goodwill at reporting, we've less the impairment already. Then current assets. What are the values for the current assets? We have 30,900 plus 13,900. 13,900. You add the two, 12,000. Hey, hey, cycle. Let me zoom it. So this and then this. Okay. So 12,500. You subtract that. You add both the parents' own and then mother PLC's own. And then the unrealized profits. Okay. The unrealized profit is in what? The parents' goods. So you subtract it. No, subsidiary sold to the parents. Okay, so you have to subtract it from, but then you're adding the subsidiaries onto the parents, so you just subtract the unrealized profit. So the unrealized profit was 400, you subtract. And then the question said something in relation to receivables. Let's check. At year ended, father was owing mother 350 in respect of these intra-group dealings. So we are saying that because you're a single entity, you can't owe yourself. So they are having owings. So one will record if one is owing the other, but could be recorded as receivable. So because he expects to receive money from father was owing mother. Nti father betros payables. A car also to of 350 to mother. Mother also recorded receivables of 350 from father. Okay, so they are saying that because you're a single entity, you're not supposed to have these two entries in your books. So this and this must be cancelled out from receivables and then from payables. I'll say cancel out. That's why receivables I've indicated what 350. And then when you come to current liabilities, 350 here, okay, as payables. And then this 350 as receivables. You are getting 41. If you add them, 68270. Now, equity, stated capital. This stated capital will bring only the parents on. Here, initially the parent was having 15,000. Initially the parent was having what? 15,000. And the question said that, oh, and the question said that, but the issue of loan notes has been recorded. The share issue has not what? The share exchange is the same as the share issue. Has not been what? Recorded. And then I say the amount that they paid, okay, for the share exchange now, has not been recorded. It means we have to come and record it in what? As part of our stated capital. How much did they pay? Share exchange, they paid 12,000. So you have to go and add it to our stated capital. And then, where is it? Okay, so you take the parent balance of 15,000, then you add what? The 12,000 to it. You get the 12,000 is the new share exchange. You get 27,000. Group retained earnings, we worked for it already. You just carry it, you bring it here. So I learned this one from Dr. Gestinado. Dr. or Mr. Lecturer Augustine Abbott. I love that man. So they said that the stated capital here, since it's for the parents and then the group within earnings, okay, is in relation to the father or the group. This total, the two of them will be what? The equity portion that should be attributable to parents, shareholders. Okay, before you add what? The NCI. But then what we've been doing most often is stated capital plus group within earnings plus NCI. It's still fine. And then the land revaluation was reserve was already in here. 2,000. You bring it. You bring the 2,000. And then other equity reserve. Initially, it was what? 500. And then we said there has been a revaluation of the equity reserve, and then it has increased by 300. So you add the 300 to it, you get 800. All right. Now, the 20% loan note was already in here, 3,000. And then they issued new what? Loan notes. And that one has been recorded. So we bring the 8,000 in here. Okay. So we get 3,800. So what some of us did during the tutorial was that if the loan note has already been recorded in investment and then you're not supposed to owe yourself, as we decided, some of us we decided to what reduce this investment by what 800 instead of coming to write it here. So if you reduce this loan note by 800, this investment by 800, you're not supposed to write it here again. Okay, so this here, one here will reduce by 300. As if 800, if you choose to subtract it from here, okay, and then in that case, you will not indicate the 6% loan notes here. But then if you choose to leave it here, since it has already been recorded, then it needs to reflect in non-current liabilities as well. So add this to, you get non-current liabilities being 3,800. For current liabilities, we have 10,000 and then 6,800. And then what? The receivables and the payables, this thing that we are canceling off, this one from this side of the statement. Okay, 350. We are canceling it off. 350. So we subtract. Now we get 16,450. Add all of them, 68270, 68270. Right? So this is basically what we did. But then my concentration wasn't specifically as to trying to get the solution for this. I was trying to basically answer some of the petty questions, okay, that I've seen people ask most of the time. Okay, so we have the solution. We solved this at the intervention that we did the last time, and then realized a lot of people couldn't make it because the info came a bit late. But then, yes, let's bear it. And the video is long. Bear with me. The video is long, but it explains almost all that I think I know so far under consolidation. And please, if you want the actual understanding, just check out on Raquel's video. Okay, let me check. This is not my piece. Maybe one carbon say my download the Raquel videos be. So Raquel Media. The only Raquel, yes. So if you go there, go to his playlist, you get corporate reporting videos. He has a lot of videos. This way I've been learning. To everyone. This way I've been learning my corporate reporting this thing from. He's my boss, so boss Raquel at the great. So I just did this one to supplement what he already have on YouTube. He's already having a lot of videos on YouTube. So this one is just, I realized he hasn't solved this question. So this is basically to supplement and then to answer some few questions that I've seen people ask me. All right. Okay. I think there are answers here as well. So if you get this PDF too, but then someone here solving enough. So mine refer to answer because a old way. All right, so this is all that I can explain for now. If I'm able to get time, I'll try and do capital restructuring. Charlie, my brain, ochina pen, ochina chini, ochina ne paper. All right, all the best to everyone. But if you have any question, you can refer to the slides. Don't come and ask me. I don't know. Okay.